Let's connect with Peter Elston. He represents Aberdeen Asset Management, joins us from Singapore. Peter, good morning. Thank you for joining us. Peter, what do you make of the course Q2 earnings have taken based on the kind of numbers we've got from India in this time? How are you picking your spots?
Well, if you look at the earnings season overall, it looks quite poor in that overall earnings were coming in around the sort of low single-digit level, but if you take out a couple of sectors, it actually was not nearly as bad as the sort of headline numbers looked. Really, the numbers were dragged down by the steel sector and the oil and gas sector, and without those two sectors, you're looking at earnings which were coming in around the 15, 16, 17% level, which isn't bad. Now, look, we're still a long way from the 20 to 25% earnings growth that we had pre-crisis, but things seem to have stabilized a little bit, having sort of rates having come down over the last couple of years. So actually not a bad earnings season.
Peter, hi, morning. You still remain bullish on Indian financial space. Would you play via private banks only, or do you think the risk reward is now starting to look interesting for state-owned banks as well?
Well, there may have been some change in the relative valuations between the private banks and the state-owned banks, but look, the way we look at things is very much on a quality basis, and for us in the banking sector, quality is all about companies that are making sensible decisions with respect to extending credit, decisions on a commercial basis. Now, it's the private banks where lending decisions are being made on a commercial basis. In the state-owned sector, you don't have the same sort of commercially driven decisions to the same extent, and for that reason we're going to stick with the private sector banks certainly for the time being.
Right. What about the performance of the IT sector, Peter? Because that has been a little mixed. You have both TCS as well as Infosys in your portfolio, and both are performing a different trajectory. Do you still maintain your confidence in both these names?
Yeah, TCS and Infosys have slightly different business models, and for that reason, they tend to have over short-term periods they can perform quite differently. But if you look overall at their numbers, returns on capital, returns on equity, debt-to-equity ratios, they're all very good indeed, and they both have very strong balance sheets, net cash positions, returns on capital in the 20 to 25% level. And the fact remains that this is a sector in which Indian companies have an extremely strong competitive advantage, which isn't going away. They are certainly beneficiaries of the weakness that we've seen in the rupee this year. So certainly a sector where we're long-term holders.
Peter, what about consumer names, ITC and HUL? So far this year, consumer staples have dominated Indian markets. HUL is up 40%, ITC is up 30%. Do you think at these levels, consumer staples are looking slightly stretched?
Well, the valuations in this sector, yes, as you say, are looking quite stretched. We're talking 30 to 40 times, and we can't really ever say that we're comfortable with valuations at those sorts of levels. But if you look at things in the context of a country which is an emerging market country with relatively low levels of GDP per capita, we're going to be talking about high economic growth for many decades to come. And in that context, these consumer stocks at 30 to 40 times might not actually be that expensive. sure, these multiples might limit upside in the short term, but you know, you have to remember that these companies are going to be growing at very high rates for many, many years to come.
Right. You also have an exposure to Asian paints as well as Nerolac, Peter. Is it also a play on the consumption theme in India?
Yes, absolutely. You know, both of these companies, paint is a very sort of basic material. It's a very easy. You know, we like industries that are simple. We like companies that are easy to understand. It's a sector that where there is extremely high growth. You know, the barriers to entry are quite high with paint. You know, the expertise that's required is such that the competition tends to be fairly limited, at least in the very high-end space where these two companies reside. So yeah, certainly a play on the long-term growth in consumption.
Peter, what about Bharti now? I know that that's been a painful position for you. When you bought Bharti, you got your entry wrong. When you exited Bharti, looks like you've got your exit wrong.
Well, Bharti has been a stock that, yes, has not performed well in recent years. As we all know, you know, the telecom sector has been plagued by all sorts of things, whether that's competition, whether it's issues on the regulatory side, and we have exited Bharti from our emerging markets fund. We remain invested in Bharti in our India fund, so it's not as if we've turned negative on the stock. The fact is that for our emerging market fund, the bar that these companies have to hurdle in order to qualify for investment is extremely high. You know, our emerging market fund is investing all around the world. We have a relatively concentrated portfolio of around 50 to 60 names. So you know, for a company to get into that portfolio, it has to be extremely high quality. And I think what we felt is, in the case of Bharti, that because of the issues in the sector, it doesn't quite you know, make the grade for that fund, but it does still make the grade for our India fund, and we're sticking with it. In terms of the timing, it may not have been exactly the right time to get out of the stock, but then you know, you can never get your timing absolutely perfect.